Good afternoon, ladies and gentlemen. It's a pleasure to host the show today. My name is Sriram, and there are three reasons why I'm very excited today. The first reason is that this is the first of the series of FinAlyzer shows, incisive talks for CFOs by CFOs. The second reason why I'm terribly excited today is we're going to talk about something which is increasingly catching the attention of all stakeholders in business and also society in general. And the third reason, of course, is those two gentlemen you see now on your screen, whom I get the opportunity to talk with. And yes, there is also a fourth reason why I'm excited. I'm on a talk show after a very long time, so that kind of adds to my joy. So, with that, let me kind of give you a background about FinAlyzer. FinAlyzer is an leading fintech organization which is in the space of helping CFOs drive digital transformation in the CFO office. And today, as we begin the first of the series of the FinAlyzer shows, it gives me immense pleasure to introduce you to Pratiq Shah and Sundar S. Pratiq is a chartered accountant and a partner of a leading professional services firm with more than 20 years of experience assisting clients in financial reporting, corporate reporting, and the likes. Given this background, transitioning to ESG was, in a way, a logical transition. And today, as the head of the ESG practice for his function, he works with corporates, helping them plan, strategize, and execute their work around ESG. Welcome, Pratik. A pleasure to have you on the show and the first show at that.
Thank you, Shriram. The pleasure is equal. Same here. Looking forward to talking to you and Sundar both.
Thanks, Pratik. And the second gentleman we have today as our esteemed guest is Sundar. Sundar is a partner at FinAlyzer Consulting. Again, a veteran in his field. He comes with about 25 years of experience, both in the manufacturing and manufacturing and services space. He has had a variety of roles as a director, as a CFO, as a finance head in various businesses. Operations, process reengineering, sustainability compliance, governance reporting are among the few of the areas that Sundar brings expertise in. Sundar, thanks to you two for coming on the show. And with you and Pratik here, I'm sure the audience is in for some interesting insights. Welcome.
Thank you, Sriram. Hi, Pratiq. Good to be here.
Yeah.
Wonderful. So before we begin, audience, if you have any questions around ESG that you would want to ask, feel free to type in your questions and we will take them as the show progresses. So with that, let's set the ball rolling, as it were. And Sundar, let me put you on the spotlight here by directing my first question to you. And I thought we would take it at a fairly high level to begin with. It would be nice if you can kind of share with us what is ESG all about, and why is it so important for organizations today, and what exactly does ESG address as a requirement?
Sure. Thank you, Sriram. ESG is primarily a framework. The full form is very simple. It's environment, social, and governance. These are the three pillars on which it stands. It's primarily a framework that helps the stakeholder to understand how an organization is managing its risks and opportunities that relate to these three pillars and the criteria around these three pillars. It's the focus is on the organization's financial interest, that focuses on sustainable and ethical impacts that the company or the organization leaves on its environment that it operates in and that it impacts. So let's simply call it as conscientious capitalism. It's not just about good intentions, it's about creating a tangible, practical plan to achieve real results that will touch our lives for the future. So today, all of us live in a world where we know that there is, the climate change going on. It has got multiple effects that touches all our lives. We have unusual rainfall, sometimes huge droughts, excellent floods, terrible floods. What ESG offers then is the company to work around these in order to touch those aspects and to positively make an impact on the environment and the society. So it's not just about climate change, it's not about diversity and disclosures alone, it's about embedding those principles across your business, right from investments, your capital allocation strategy, to sustainable innovation. That's the sum and substance of ESG.
Thanks, Sundar. And Pratiq, taking off from where Sundar left off, he spoke about real and tangible action. Okay. And he also spoke about a sustained focus around this in terms of capital allocation, in terms of having certain standards, etc., around it. And in this context, my question to you was, we've been hearing about sustainability for a long time, and there is a lot of work that organizations have done in this regard. And corporate governance standards, again, are baked into any sort of corporate setup, either through regulatory norms or through individual initiatives taken by organizations themselves or through the board. So there is a lot of work that has actually gone on in this space for a long time. So how exactly, in your view, is this entire framework of ESG different from what has been done in the past? And why do you think that would be what is coming up now, or what is in prevalence now as ESG, is something that is much more stronger and something that will yield something real and tangible as in this?
I think that's a great question, Sriram, and thanks for asking this. So let me first start by discussing where you asked me about the difference, but let me first talk about where the commonality is between ESG and sustainability. And as you rightly said, it is oftenly used interchangeably. If I answer in a very short and sweet answer, from a subset standpoint, ESG can be a very small subset included in the part of the sustainability piece as a whole. But where the difference comes in is in what actually Sundar talked about. Sundar very clearly explained what does ESG stand for. Now, ESG has very clearly been defined in terms of environment, social, and governance. When environment, we talk about climate, and then greenhouse gases. We can talk about n things around those. Social is about the ecosystem, the stakeholders, how they get impacted, and governance is about transparency and how well the policies that organizations made are implemented. Now, those are most of the measures which are measurable and quantifiable and can give a very rollable and a comparable benchmarking to corporates. Now, when you talk about sustainability on the other hand, that becomes an area which is really different for different people. Now, sustainability overall is a very wide concept, and it could be different in the way you project it. Let's say you could be bothered about sustainable investment, but I could be bothered about sustainable growth. You're using the same concept there, but the application differs significantly. When I look at investing, I'm looking at whether I'm investing in projects where it's more of a sustainable, so where I could factor the ESG parameters as well, but it could go beyond. When you are looking at from an investment standpoint, you are looking at investing in entities which have a sustainable track record or which have a plan in the future of how the sustainability aspects will grow. That's where the difference for me comes in. Again, both are interchangeable, both have a lot of things in common, but how do you apply it is where the difference comes in. And ESG, in its very core form and the way it's going throughout the world, makes one aspect very, very easy for corporates to do, and even for stakeholders, is compare. Because when people start measuring on the ESG parameters, comparability becomes easier, which today, in some form or the other, because there are so many varied guidances and benchmarks and strategic formulations, frameworks available from sustainable reporting, that every report could be different from the other one in its own basis. That's where I think I would put the stark difference between ESG and sustainability.
Thanks, Pratiq. And continuing that thought a little bit further, you spoke about a lot of benchmarks that exist out there, and and you also spoke about the point of view when you gave the example of investment versus growth. Would you be able to quickly, and you worked again in this space for a long time, uh, blending these two together, would you be able to talk us through the phases that ESG reporting at a global level has seen? The typical 1.0, 2.0, 3.0 kind of uh, demarcation, if one could call it. How's that played out?
Sure. And then again, Sriram, to I think explain it more better, I will try to bring it back home as well, because if I see the way India has gone over the process for the last 10, 12 years, has seen a very gradual but a very decisive increase and an acceptability in terms of its CSR or sustainability or ESG or climate change goals. So we talk about the entire change which started from the CSR policy, which was introduced in the Companies Act. And most of the people would know how slowly and gradually the rules were implemented. It gave a very definitive roadmap of where it's going, but at the same time gave corporates a very long room to get adjusted to what the new rules are. Just to talk about it, initially when the CSR thing started, it was mandatory to deduct the 2% amount of last 3 years average profit. But the investment and the utilization was not a mandate. They just had to disclose that the amount was fully spent or not. After a few years, the government said now we are making it more stringent, that now if you are not going to invest that or spend that 2% amount, then you have to within some time invest that back into some government fund. That was how gradually the requirement from a CSR standpoint increased, and then CSR spends were gradually and only spent towards the entire piece of how the entire event around social impact, around corporate sustainability aspects were spread across. Then gradually we saw the movement happening towards the BRR reporting, or what we call it the business responsibility report. Now again, there you can see it started with top 100 companies, then it spread to 500, and then it spread to top 1,000 companies. And then if you look at the BRR report, the BRR was more about qualitative aspect. It was more subjective. It gave a lot of aspects about what a company is doing, but still it had some room for interpretation. In the interim, SEBI also introduced the concept of integrated report, which was based on the concept of integrated thinking. Now, if you look at the overall reporting standard, how the entire framework for IR has been defined was a beautiful concept, because it took away the focus from today and yesterday and brought in the element of tomorrow. And it just broke up the tomorrow also into three smaller steps, which is short term, medium term, and long term. So it required companies to put up its strategy, its objective, and what are the steps which are taken by the corporate to reach that particular strategy and objective was a very important element of the IRBs. And that, in a way, talked about the six capitals in the business model, and all of those capitals, in some form or the other, captured all the elements which were factored in sustainability and or ESG. So that's how the move for IR came in. And we can see almost 200 companies in the country have now adopted it in varied forms, because the framework itself allows two or three options to adopt it. But then the reporting and the acceptability between the stakeholders has significantly gone up. And the last but not the least is the BRSR, or the Business Responsibility and Sustainability Reporting, which is now mandatory for the year FY23, and it straight away hits the top 1,000 companies by its market cap. Now, this is a huge leap, because this makes India one of the only countries making an ESG reporting mandatory. And as I answered in the earlier question you asked, this answers the fundamental question: how do I compare corporates? Now, because you have a standard form, all the KPIs have been stated that this have to be reported. that report makes comparison between company A and company B, or within the same industry or outside, very, very easy. That makes it easier again for the lenders, for the stakeholders to assess what they are doing and make their decisions much more informed. That has been the overall growth from an India standpoint. If I just go back to your question, what has happened globally, I think it's in the same direction. Sustainability has been an area for almost over 2 decades. And it started with the Kyoto Protocol right into the 1990s and 1980s, where they talked about the carbon emission and the requirement from there. But now getting the ESG spotlight in terms of clear, demarcated, identified KPIs is becoming a trend world over. I hope that answers the question, Shira.
Yes, Pratiq, it does. Thank you for that insight. And I like the way you started off with India and kind of, uh, uh, sort of did an inverted funnel and took it up. So kind of places into context what has been happening since about 2 to 3 decades. Thank you so much for that insight. And Sundar, taking a bit from taking it a little ahead from what Prateek said, one of the points that I noted, or a couple of points that I noted down on what he said was, of course, around benchmarking that helps comparison of where one stands vis-a-vis ESG, and also vis-a-vis what others probably in my realm of industry are doing. The second thing which kind of was really compelling for me was around organizations having a not just a yesterday today point of view, but also a tomorrow point of view. And also Pratik spoke about having a short term and a medium term and a long term strategy around it. And he also spoke about how the compliance requirements started off with 100 companies, then it kind of ballooned to 500, and now we have 1,000 companies that need to comply. Given all this action, what do you see on the ground, Sundar, vis-a-vis the state of preparedness of organizations, vis-a-vis embracing ESG as a culture, putting in place resources for that, investments, human capital for that, reporting mechanisms, educating employees. How do you see the entire thing playing out based on your experience dealing with organizations?
Sure. I think Pratik hit it on the head. Primarily, ESG focuses on comparability, which means standardization, which provides a good benchmark for us as investors to compare one company versus another and to estimate where each one is on that scale of, let's say, 1 to 10. And that is the crux of the objective behind any metrics that goes around it. There are a lot of trends that go in. Of course, Pratik also very clearly laid out that the entire reporting framework of ESG is in its infancy, not just in India, but across the world. In India, of course, we started with BRR a few years ago. It's been doing pretty well. A lot of these companies now fairly give a lot of these information around the 9 principles, the details. The most important thing as far as the BRSR is concerned, or any ESG reporting, is to understand what our stakeholders want. So step A is to identify who our key stakeholders are for any company, then go about with engaging with them to assess what our material sustainability topics would be, which would be of interest to them that we should disclose. Now, industry has been focused. A lot of these companies, the top 200 companies, now have a fair, if we generalize that, it comes into 5 broad buckets. So we have health and safety, you have climate change, you have, let's say, waste management, supply chain, and you have human rights. Now, these 5 buckets are pretty common and across all the, the major companies that have been reporting so far. The other theme that goes around is all companies have got mission, vision, and goals to marry the requirements of sustainability. So the sustainability themes are now getting linked back to enterprise missions so that there is a time-bound action to achieve the sustainability goals. That's another aspect that we are seeing on the ground. A lot of movement towards that, a lot of focus towards that. Similarly, independent directors are now getting up to speed. Some companies are also including people with experience in sustainability operations as well as on ESG itself across the world. So board evaluation and the way the boards are getting tweaked and reskilled to help companies to achieve these objectives and to guide the companies and the management to achieve these sustainability objectives is another area. Sustainability performance is now being rolled into board evaluation processes. That's another aspect that we see very often among the larger companies. There's another very interesting aspect that we've seen in a few companies, which is linking the sustainability metrics into managerial remuneration. This is a little less common at this point, but that's another area which is picking up, and the better companies and the leaders in this segment are rolling that out. Out of the companies that have reported so far, more than half of the companies, I think, have now disclosed their emissions on GHG, water consumption, biodiversity. So waste management practices, energy efficiency in operations, these are stuff that good companies anyway are doing. Of course, Pratiq clearly laid out how our CSR background helps us, and so that touches the society and the community aspect of sustainability reporting and BRSR reporting. And there, I think companies have got off to a good ground. They've been reporting out good information on CSR, and all that helps as far as one pillar of the entire ESG BRSR framework reporting is concerned. The other aspects that we should think through and where companies have a lot of focus is not just on board reskilling and tweaking the constitution of the boards, but also on leadership. Now, one director has to be named as part of the BRSR report, and the management has to be clearly laid out and identified, which means that there is a significant amount of scope for BRSR professionals, or rather, let's say, sustainability professionals. The larger companies are also being very proactive. They are getting in the involvement of their value chain partners, both on the supplier side, on the back end, as well as on the front end with the customers. Third-party assurance is another very interesting area where if you have good data, then you can go ahead with verification standards, implementation of internationally accepted verification standards. You have at least the ISAE 3000, you have the A100 AS. You have a few of these international standards which are pretty well prescribed. And that's another area which good companies and the proactive leaders in this industry segment are currently implementing. That's on what they are doing. So how do they do that? For which they got to have the right talent. Most proactive organizations now are trending towards hiring a CSO, a Chief Sustainability Officer, or one person who's in charge of sustainability reporting itself. So all this is being tweaked, and the add-ons come in. Independent directors, like we mentioned, are already equipping themselves, which brings us to the third domain, which is if you've got the people and the process, then you need to have the technology for it. So project management software, other tools, many of them at this point of time are in-house built in the very large organizations. The smaller organizations, of course, work on Microsoft Excel and a few of these tools, but then with all their limitations. But tools are going to be very important, because if you don't have good data structures, you can never get yourself audited. And that's going to be a very key area. If you're going to have the right kind of tools, you're going to have a requirement of budgets. So if you want to plan for budgets, we do urge CFOs to plan on 3 counts. Plan on your project management of this implementation itself. Plan on the software, the tools that you're going to be requiring and that you will need to implement as you progress in this journey. And finally, the actual people costs of implementation. So these are the 3 aspects that we should definitely ask companies and CFOs to look at. The proactive organizations have already built these aspects into their 2022 budgets. Those who are a little bit later into the game need to catch up very fast, because we have 4 months down the line, and then we have to start seeing the results as at 31st of March 2023.
Thanks, Sundar. Thanks for that detailed insight into what is happening. And as I see, there is quite a bit of ground that has been covered, especially by companies who are kind of caught on with the game early. Pratiq, are there any insights that you may want to share in this dimension on what you have seen, companies doing based on your interaction with, say, the boards or the CFOs or the CEOs?
No, I think Sundar gave a pretty great insight. 2 points I just want to add to it is uh, their maturity, which is being brought up in the entire reporting as well. See, in a way, I somewhere believe that unless these elements find a place in the financial statements where you can actually quantify and show the result on what we call as a bottom line, this somewhere get into the background. Now with ISSB, which is an IFRS Foundation offshoot, which is focusing only on the sustainability standards. They have two standards already in the draft mode, IFRS S1 and IFRS S2. And similarly with even the SEC, who have come up with guidance on in terms of what requires to be done in the financial statements. I think to what Sundar mentioned, these are going to be information which is going to be quantitative, really map the financial reporting. And along with that, what becomes mandatory is the assurance and the audit aspect of it. So all the elements that Sundar talked will be really important. So now very soon from a separate report which was being presented on sustainability, we'll find all of that finding its place in the financial statements and then depicting and making a very different story in terms of what the investors want to see.
Pratik, staying on about investment in technology and also the quality of data, making it far more easier to report it, etc. So what is your take? He also spoke about the fact that a lot of organizations are still managing stuff through Excel sheets, etc.
Right.
My view is that I don't think this would sustain as a practice or as a process, because it is, as you rightly pointed out, it's now part of the reporting. It needs a lot of discipline around it. It needs a lot of, the data needs to be clean. It, of course, needs to be accurate. So how do you see the entire technology piece playing out in the reporting aspect of ESG?
I think very fair ask, Shriram, but I probably believe when we talk about the reporting, I think technology can play a very crucial role in the entire aspect of ESG, right from implementation to decision making to the external reporting. And I always believe external reporting is a culmination of all the activities you do throughout the period for which the reporting is being done. Doesn't matter whether it's quarterly, half yearly, or the annual periods. Now, and then again, to what Sundar mentioned, the most important aspect is data collection and the quality of the data. And more and more we have advanced systems. And then this is going to be important because it's not just like a financial data which moves through an ERP, right? All advanced corporation would be using an advanced ERP, and the data moves through the system with a very logical set flow. When we talk about ESG aspects, the rules around that are diverse. The policies application by corporates is different. What applies to a entity A may not apply to entity B. Or if it applies to both the entities, the way it applies and which computed could be different, because there are different benchmarks available in the global scenario which corporates are using. So how do you get that synchronized? How do you get that aligned is very important. If you talk about a conglomerate which is spread across the world, they might come up with a single KPI, which could be a single number for the entire entity on a console basis. But just imagine if the base computation models are different. Are you relying or are you giving up a number which is reliable? The question is no. I think that's where the most important aspect from a data collection perspective comes into play. The moment you talk about data and collect and numbers around it, the important question that comes up and where not just the external or internal auditors, the management themselves will have to start relying on and then come up with solutions is the systems and processes to gather that data. Is it foolproof? Is it allowing a lot of manipulation coming in the system? How do you have a parallel check? All the financial reporting that happens has a significant amount of internal controls in place. You will have to have the same thing for this data which goes out as well. The third one is ESG is not just a disclosure aspect, right? ESG, the way I talked about from an IR standpoint, will have to have its importance gained over time by infusing that, embedding that into decision making of the organizations. That can only happen if information is available online at a press of a button. So corporates might have to think of solutions, getting a dashboard which is available 24/7 to know what's happening on the critical parameters based on their materiality assessment they have done. The next one could also be, again, to what Sundar said, external assurance point. Do you have an audit trail available? If changes are made, can systems identify what is being done? How do you come up with those solutions? Today, emails and exchange over WhatsApps may not be the right source. Do you have a system in place which can collate data, which can come up with its own trail of data, document generation and queries sent back and forth? How is the review mechanism? What are the maker checker checks? What we call as the 4I principle? Is that all set within the organization? That's going to be very important. Reporting is, as I said, the last funneling of the entire process. Reporting, does it take its data from a single source of truth? Right? You need to have a single source where information is collated and then sent out. There could be multiple sources of information. What a plant manager could share could be different from what a corporate finance function leader could have. Is the same data been, and if there are changes, how it has been reconciled? So those things are also need to be very important from a technology standpoint. Last but not the least is around the training. This is an area which is evolving. For corporate reporting, we can say there has been 30, 40 year of education, training, and experience built into it. All of that we are expecting in a 2-year framework. How do you get people up to speed? Using platforms by various means. It could be e-learning, it could be virtual mode, direct mode. How are you going to train people at all levels, right from the board to the people at the plant? This all could have a very strong technical and technology implementations. And then the most important one is constant calculation of the KPIs. If you're looking at carbon emission of a plant, is that carbon emission computed on what basis? Is it live? Is it real time? Is it based on a monthly, weekly, or a yearly average? How do you compute those? So these are the important parameters where I think technology can play a very important role.
Thanks, Pratiq. I think you summed it up beautifully in terms of, it's not just the collation of data, but also the source from which it comes in, the quality of data, how is it getting reported, how is it getting tracked, at what frequency, etc., and then how is it getting reported. I think that's a very holistic point of view. Thank you so much. I think we are very close to the close of play, as it is called. So I just have a couple of questions before we sign off. And the first one is I thought both of them actually are something that I would love to hear from both of you. And the first among them is I do hope those who are listening in, the leaders, the CFOs, and the C-suite who are listening in and who still are on their path in this ESG journey. For those folks, Sundar, what would be your, how do I put it? What would be your point of view? And how do they begin this entire journey? Because it kind of, if I were one of them, I'd find the whole thing intimidating. Concept is one thing, me buying into it completely is another thing. But getting my hands, dirty and actually getting down to work does seem a little bit intimidating. So Sundar, how does one kind of, where do we start? If I can put it as simple way. How does one start?
Excellent question. See, the most important thing that we need to keep in mind is the end goal, which is March. So it's like the 10th standard exam and you hit the 31st March deadline, and that's when the exam is going to come up and test us for our preparedness. So the most important thing then is to figure out if I have started my journey 1 year back and started reading my books, in which case I would have started with my syllabus, then I go into my learning objectives, then I go into any other guidebooks, any other additional material, reference material, etc. So in terms of BRSR reporting, what would I do? I would go ahead and say, okay, let me define my objectives. Let me decide what my scope is, what my approach is, whether I have my management buy-in on the approach, whether I have my stakeholder buy-ins. How do I then get into my specific goals, my KPIs that Pratiq brought out, bring that into the business plans, time my timelines, target my milestones, accountabilities, narratives, All that would be there. Then I coordinate with my stakeholders, with my other interest groups, understand the role of third parties, lay out what my border is, then evaluate how that is in my maturity curve of the ESG narrative, benchmark my performance against industry. I would then implement all these things, map it back to my SDG goals, back to the India principles, and then my policies, my application of those policies, and how well I've trained my people, and whether there are any issues against those particular trainings, whether any feedback has been received, etc. And finally, I will tie this back to my MDNA, my management discussion. Uh, I will tie it back to my liability statement in my financials, my contingent liability disclosures, my CSR reports, and other non-financial information as well. With all that wrapped up, I'll go ahead, disclose all this information as mandated by SEBI and upload the XBRL file. Now, this is if I have 1 year time on my hands, when I have all the time in my world. But now we are in the last 4 months, and if we've not done a little bit of our work, our groundwork over the last so many months. Now, remember, we also need to collate data, comparative data from 1st of April 2021. So how many people we trained, etc. All that data needs to come in from April 1st, 2021. So those comparatives are also required for this BRSR reporting framework. If we have not done all that, and my 10th standard exam is right up the door, then I would go ahead straight away, refer my guidebook, and see how best I could, how quickly I can still manage to get my pass marks, or at least my 60%. In that case, I would then go ahead with tools which are available. I would look at whatever tools, I would look at the guidebooks, and I would say, okay, let me see what other companies have done, who are the experts in this area, and what my tools can do for me. So tools typically should be able to come back and tell you, okay, it can give you a pre-built solution. Based on your taxonomy, it should load data from multiple sources, seamlessly map financial, non-financial ESG data. Pratiq spoke about reportable KPIs. Built-in logics should be built in for submissions, data aggregation, approvals, etc. And then the tool should have the ability to create and automatically insert ESG disclosures into our reporting framework, so that, like Pratiq mentioned, you will have an integrated report. So as at 31st March, while we all know that Rome was not built in a day, now we have the last 4 months to build our Rome. So that's where we will be. Pratiq, do you want to
Thanks.
add to that?
I think Sundar, not much that you have left out. But if I have to just share the way I think the top 2 or 3 elements, Shriram, that I would believe is the way to go forward is first, I would quote Mr. Stephen Covey. It's always best to begin with the end in mind, because it's important what your goal is and how do you want to achieve that, and then the entire road can be laid around it. Second is the materiality assessment, identifying what are the key material items for your company. It could be different for different corporates. That's a very important element to keep in mind. And based on those materiality aspects, identify the key elements, and then start focusing on the ABC and categorization, or however you want to split it. And the third one is identify the right risks, the immediate ones and the one which could be remote as well. So I quote this example many times. Often, many corporates thought that if you have one disaster recovery center, it should be okay. But nobody expected an event like a COVID, where every of your office will be required to be shut down. So even those things are possible. So how do you have a remote plan as well, and how can you quickly put that into motion? And at the same time, working also on opportunities, how do you ensure those can be taken care of in the right way?
Thanks, Sundar, and thanks, Pratiq. I think that is pretty, at a high level, that kind of lays down on what needs to be looked at. And Pratiq, I like both of you, I think, started off, though you expressed it in different ways, is keeping the end in mind, and then see what is really relevant, applicable to us, so that you don't kind of end up boiling the ocean and getting yourself into further trouble. So I think that was pretty insightful, and I'm sure the audience would find that pretty useful as a tool to start their journey on. One last question before we sign off. Uh, Considering that there's so much that needs to be done, and also considering that there is enough pressure within the ecosystem, if one can call it, on how it should be done, etc. Uh, what do you, Pratik and Sundar, see, or how do you both see ESG being a differentiator for organizations in the years to come?
Okay, let me give it a shot. Maybe then Sundar can add to it. I think there are many parameters, Sriram, around this. While if you ask me, has this been measured? The answer maybe is no. Again, it's in a very nation state, but there are some really five, six elements that could stand out, and then we see this happening. First is, of course, when we start measuring and then look at the real thing, is getting finance available, which could also be cheaper. I think that's one of the elements that ESG acceptability will bring in significantly high. Is that the case today? May not be in its entirety, but the way we are going, I think it's definitely going to make a difference in terms of getting finance, which is going to be cheaper compared to what people in the same area are not doing with from a ESG standpoint. Second element could also be from a talent retention and acquisition. As we see, and in what we call as the Gen Z or the millennials, their acceptability of corporations who are much advanced in the sustainability and ESG roadmap is much more than entities otherwise. So that is something which is also going to be very important, and then we are seeing it as we progress. And I see it with my kids. When I open a plastic bottle, they're definitely eyebrows raised, and I'm not able to answer why. So if it's inculcated from that very young age, you can imagine when people are in their teens, late teens, and early 20s, it's going to be all the more important. It's a generation mindset change, and then we may not be able to see, if I talk about myself only in my generation, but the generation next will definitely see a difference, and they are seeing it. Thirdly, is also acceptability in terms of the vendor ecosystem, be it debtors, be it creditors, the entire aspect of it. If they have to choose between two parties, they might choose with the party which is going to be more ESG compliant. Even from a human resource standpoint, because the transparency increases, there is much more social value added to the entire organization. It makes it more sticky for people to stay around. I think these are a few of the elements that really come to the top of mind. I'm sure there are many more, but these are the top four which really come to the top of mind as we speak.
Sure. Thanks, Pratik. Sundar, your insights on this dimension?
Yeah, I think Pratik said it beautifully about Gen Next and the entire thinking getting changed. Let me add a little bit of finance aspect to it. So, what do CFOs look at? In most now, let's face reality. In every company, it is the CFO who drives this entire ESG reporting exercise that we have seen. Very few companies have done it otherwise. This is generally done along with the CSO if the person is there. Otherwise, it's almost virtually done by the CFO and the CFO's office. So what does the CFO then look at? He looks at top line, the revenue. Now, if you've got more sustainable products, then you can attract better customers, you provide better value added to your thing, and you have better pricing power. That's your value proposition one. Value proposition two is cost reduction. How will you do that? You're now measuring more the power, the water intake, recycling, etc. So then if you've got better measurements, you can do better cost reductions. Third aspect that a CFO typically looks at, and the risk advisory and the risk team generally looks at, is the regulatory and legal interventions. Now, one of the legs that we have of ESG is better governance and compliance. So you have lower cost of doing business. Fourth aspect that CFOs would always look at in every investment decision, capital allocation decisions. So every time you do a sustainable plant and equipment and process related investment, you're looking at capital allocation, you're looking at ROI. And these you look at independently of whether it's good for your business or bad for the business. And that's the best way to make a decision. Now, if it is good for your business and it is good for the environment, then that's a double bonus. There's no other way that you can make that decision. So these are the four major things that CFOs look at. And that's why this particular aspect is a very strong value proposition for any company.
Thank you, Sundar. I think that makes sense, not just from a financial standpoint, but also as a standpoint, but also from a standpoint of how one perceives ESG as a principle itself. So there's always you're in a way addressing the larger context and also looking at the financial implication of it. Thank you so much, Pratik and Sundar. I guess that's all we have time for. Thank you for your insights, and The audience, thank you for listening in. As I mentioned at the beginning, this is the first of the series of FinAlyzer shows. We will soon be back with our second show, and I look forward to seeing you, hearing from you again. Do write into us at info@reallsquare.com for any queries that you may have vis-a-vis your ESG reporting related platform needs, and we will be happy to get back to you. Thank you for your time. Thank you for your interest in listening in. Thanks, Pratiq and Sundar, again. All of you have a wonderful evening. Take care. All the best.
Thank you, Shriram. Thank you for having us here. Thank you, Sundar.
Thank you, Sriram.